How much cash do you typically hold, and how do you decide on that? I think I addressed this question earlier. Like I said, we are bottom-up investors. We believe that our investment process is going to give us new ideas to invest in and tell us which existing ideas to exit, add to or subtract, obviously, too. And we view cash as a byproduct of that investment process. Now, once cash is in the portfolio, we view cash for its option value. And that means that holding cash has costs, obviously, by missing out on upside, but also has the benefit of giving us the option to invest in something in the future. And if you think about valuations across the market cycle, as valuations come up, if you knew that the market is going to go down by 50% tomorrow, you definitely want to hold cash. But people think that they want to hold cash only because they think cash is going to protect their downside. I think there's an even more important reason to want to hold cash at that point, which is cash is going to give you the ability to buy stuff that you really like, that you've been waiting for, at much steeper discounts. And as the market cycle progresses, and we find fewer and fewer existing options, we think of cash as us comparing today's options to tomorrow's options, today's opportunities to tomorrow's opportunities. And so we're thinking, in a sense, across time and across investments, and trying to decide not only which investment is best for me to make today, but also which investment may be better for me tomorrow. And there may be scenarios where you should hold cash, where essentially, in our case, the investment process is telling us there is an investment opportunity that's going to exist 1 or 2 years from now, and the cost of forgiving whatever return for the next 2 years is going to be more than compensated by how much you're going to make by being able to buy that investment at a much lower price from now. Let's take one from the floor. Mark?
Just like a related question to your cash position is, do you hedge the portfolio for FX or markets? And that, in context of your cash position, is it possible to predict how your portfolio will perform in different market environments?
We have the ability to hedge, though we almost never do. The reason that's the case is, our third partnership principle is that we will focus on the long term only and will ignore short term considerations. The overwhelming benefit of hedging comes from short term considerations. So that's basically the conceptual reason why we may not want to hedge. A position where we may want to hedge is if we are exposed to a currency that does not fit within essentially a diversified portfolio, and we have no opinion on that currency. The problem with that is, we used to own an Indonesian company 2 years ago, and we didn't have any particular position on the Indonesian rupiah. But the problem with that is those currencies that are in that position also happen to be currencies that are very difficult to hedge. And so while in theory we may want to do it, in practice it's not doable. And so we just deal with it by sizing the position accordingly, knowing that we have taken a risk indirectly by not having a position on the currency. What was the second?
And then your performance in different market environments?
Yeah, the overwhelming points of outperformance for us has happened in down markets. Our portfolio has outperformed the benchmark in 72% of periods where the benchmark has declined, which you should expect given our conservative nature to valuation. But that's also why our strategy could struggle if you had a market like the past few months where it's shooting straight up. And that applies to most value strategies, I think. You're going to be in a position where you need these down markets or volatile markets, which are normal markets, to be able to capture that differential alpha in down markets. And we're happy, historically, basically, we've massively outperformed on the downside and matched or slightly underperformed on upside markets. The most extreme case of it happened in the Great Financial Crisis, where we outperformed the market on the downside. The market was down almost 40%. We were down 24%. And the reason that's important is that the upside from a much lower drop is easier. If you lose 50% of your money, you need to double it to break even. And so in 2009, by the end of 2009, we had already broken even to our 2007 level. It took the market another 4 years to break even, which meant that gave us 4 years of making money above the benchmark.
And was that, do you think that was mainly a valuation argument, or is that also a function of your capital? The capital structure of your portfolio is presumably stronger.
We had almost no cash.
But the companies are less leveraged, presumably, than...
For sure. I mean, back to the earlier part of the discussion, when we looked at the return on equity of our businesses not only earn substantially higher returns on capital, they have substantially better balance sheets. The bulk of our portfolio companies are net cash. And that definitely helps on the downside. The reason it helps on the downside, which is even more important than the stock not going down, is that it gives them the option to invest counter-cyclically. If a company is surrounded by competitors that are bleeding, has substantial cash and access to debt, they can acquire companies, they can acquire customers, they can invest on the cheap. That's the type of business we want. One of the questions in our checklist actually looks at the behavior of management and whether they've invested counter-cyclically in downturns. A perfect example of one of our biggest holdings is Henkel, where you see the balance sheet expand in downturns and then shrink as the economic cycle goes on. And so they invest essentially against the cycle, taking advantage of downturns to make aggressive moves that competitors cannot make because they're reeling in their positions.